Good evening. My name is Keisha Rogers, and I want to welcome you to our LaRouche PAC Monday discussion for May 8th. And we usually have these as strategic overviews, and we're going to expand our strategic overviews with a new type of discussion on the question of filling out the picture of the institution of the presidency and a project for a real American presidency. So I think Michael and I mentioned this on last week. For those of you who are new, we're going to take this question of what we've been developing around the importance of Trump's Agenda 47, President Donald Trump's Agenda 47. And we're going to be discussing tonight with Brian Lantz, who has been very much in the center of presenting what is needed as key policy steps to realizing President Trump's Agenda 47. And you can find a lot of his discussions and filling out of this picture with discussions and interviews that he's done with Susan Kokenda on our website, larouchepac.com. Now, I do want to show people what we're discussing here and talking about with Agenda 47 on our website quickly here. All right, so here is on our, actually, let me go back for a second here. So this is our webpage, and we feature a number of President Trump's policies that he's laid out. One that we're going to focus on and have been focusing on, many of you have heard us discuss this concept of building new cities, new freedom cities, and we've developed that quite a bit. But I think we're not just talking about building new cities, but when we look at the question of what's happening with the breakdown of our banking system, you see every single day something's coming out about another bank failure. And this has been part of the globalist agenda, the anti-American system agenda, which President Trump, what he's laid out in this very profound question in his first Agenda 47, a quantum leap in revolutionizing the American standard of living. We're going to dig into that a bit more. And Brian is going to take up this question of how do we transform the nation back to a productive nation, away from this globalist World Economic Forum, away from this agenda that has been put forth that's destroying the family formation and the family structure, and say, how do we allow for young people to be able to have, what is it going to take for us to have a society that, and our economy that can have a single income household? And I don't know if you all have been thinking about that or think that's too far-fetched, that we can actually have a household where you don't have parents working 3-4 jobs. We have a single income household, and that parents can actually, the family formation, 2 parents, husband, wife, so forth, can have children, and they can actually provide American standard of living, called for a baby boom. And so how are we going to have a baby boom in this culture, in this economy right now, when everybody's focused on a monetary system versus a productive system? Well, that's what we want Brian to talk about tonight. And he's going to lay out that picture for us, because right now, the only chance for victory is that we have to secure a presidency in 2024 with President Trump, with this Agenda 47 as the main driver for economic progress. And this is something that LaRouche PAC has been extremely passionate about. So with that, I'll come back into the discussion. I want to encourage all of our friends listening on YouTube, on various other channels that we're going to post this on afterwards, to feel free to write back in questions so we can continue to dialogue on the economic policies that are needed. So with that, let me go ahead and turn it over to Brian, and I'll look forward to hearing from you on the call tonight with your discussions and comments and what you'd like to hear us continue to take up on this question of the project for a real American presidency. All right, 1 second, please. Brian, go ahead.
All right. Okay, well, good to be here. Thank you, Keisha. All right, well, I think most people are aware, certainly should be aware, that a lot of young people, in fact, probably most young people, are wondering these days about whether they can start a family and continue the support of a family in the conditions which they find themselves in, and that's something we have to address. As Keisha was saying, President Trump, with Agenda 47, is proposing we've got to get back to, what used to be called a breadwinner household, a single income supporting a family. How are we going to do that? So we want to talk about that tonight. What is really a real living wage. That term gets kicked around, but just raising the minimum wage or something like that doesn't do that by itself. And secondly, I want to just bring in that context, cryptocurrencies. And the reason I want to do that is because a lot of young people out there, and Keisha has some figures on that, but a lot of young people, in fact, it's the majority of people that are investing in cryptocurrencies, Bitcoin and whatnot, are under 40. They're young. They're looking around. Where can they invest? Not the stock market, bonds. They can't afford a house. It's very difficult. It's disappointing, to say the least. It can be very pessimistic, and so crypto is one place which is being looked at. It's alongside of there's the idea of the gig economy, but the idea of being a coder, that's not so great. I mean, you got this chat GPT is being coded by people making $15 an hour from their apartments. I mean, this is not enough to support a family. The gig economy overall, I mean, if you're single, or if you're a couple but you don't have children, maybe you can eke by, but that's not going to work. And of course, young people think, well, maybe I can become an influencer. I can name brand myself and get on TikTok, but none of these work. So, but on the other hand, look, we've got an explosive political process underway right now. It's just really breaking out, and we really have to look with fresh eyes, around us in our communities, our neighborhoods, our workplaces, and so on. Look, I mean, just on the surface, I mean, you have President Trump and the MAGA movement. You have LaRouche PAC, our critical role in that. But now you got Bobby Kennedy Jr. Speaking out on immigration policy. You have the growing opposition to the war in Ukraine, this insane escalating war in Ukraine. You have all of the social issues, gender fluidity being pushed in the schools, et cetera. All of this combined, the debt ceiling crisis, all of this is just happening around people. Look, I mean, baby boomers, they're not thinking at least sufficiently about the next generation and the generation after that. What we have to create now haven't been up until now. They're looking at their 401ks, They're now worrying about whether Social Security is going to hold out, or Medicare is going to hold out, through the rest of their lives, and that sort of thing. But now in this exploding political environment, you have a shift going on. You have a shift where people are really beginning, and we see this. My wife Evelyn is at a Republican Central Committee meeting here in Houston tonight. You see this in all kinds of areas where people are really trying to figure out not only what's going on, but what we have to organize. So I think this is really just important to bring forward, and people can come up with their own examples, and maybe we'll hear some more in terms of reports as we get into the question and answer. But crypto is not a great option. All right. So, but among many young people, well, they may be sympathetic to what LaRouche PAC is saying and developing in quite a bit of detail, what Trump is advancing. And as Keisha said, really look at Agenda 47, what Trump is putting out there in terms of very specific programmatic initiatives. But they also, I think there's a tendency to say, particularly in this environment that has existed up until now, that seems all pretty far off. That's not really, shall we say, practical, but that's not the case anymore. That is simply not the case. The program that President Trump and with his Agenda 47 is advancing, and what LaRouche PAC is advancing, is the solution. And it's something that can be done now and must be done now. We have an exploding, in the positive sense, political environment in which a lot of different people, from Elon Musk, Tulsi Gabbard, to Aunt Rand Paul, to you name it, Vivek, this new presidential candidate on the Republican side, is raising noises about against the Federal Reserve. It's just it's really coming out everywhere. So what I really want to first of all, let me just say right off the bat, in terms of a breadwinner household, we only have to do two things. One is we have to continually develop the productivity of our workforce. We've been bumping around at, officially something like 1.3 or 1.4% increases in productivity. And that's almost all in computer chips and that kind of thing. It's not that significant when it comes to, feeding and clothing and so forth, families and houses and the economy overall. We've got to change that in terms of the economy as a whole. And how do you do that? That's through scientific and technological progress. That's by investment into the real physical economy of our nation. That's something that President Trump wants to do. His proposal for up to 10 new cities in the West on federal land is an initiative along those lines. The Artemis program to take us to the moon and Mars is a science driver to generate those kinds of spinoffs. So there's that. And all of that, and all that can be developed out of that. Secondly, and this is very important, is we can change, over time, we can change the composition of our workforce. Even McKinsey Global Institute, Wall Street outfit will say, something like 78% of the workforce is currently in services. That's an approximation of overhead. Those are people. Many are important. Doctors, nurses, and so on are important. They contribute, but in terms of the actual number of producers, it's shrunk to a tiny number, less than 8% in terms of manufacturing. So think of what we could do in terms of increasing the wealth of our nation, the physical output of our nation, by righting the boat, turning the economy right side up again, putting more and more people back to work in productive jobs, taking them out of low wage hotel jobs and restaurant jobs and paper shuffling jobs and so forth, and putting to work in the real economy. emptying out some of these high rises. I mean, they're becoming empty anyway. These office buildings. Those two steps, getting back on the track of rising productivity, output per capita, and shifting our composition of the workforce back to production, to the real growth of our economy in terms of real wealth, then gives us the resources, the bounty with which to offer a single payer wage, which would today be somewhere in the range of $35, $50 an hour. That's just based on, a very conservative figure in terms of what would be required given the actual costs in today's world. We can also, by being productive in this fashion, we can bring the costs down. We can take the speculation out of the economy. So we can bring prices down as we bring the breadwinner's income up, and therefore create the conditions for growing families, healthy neighborhoods, healthy communities, and a transformed culture. So let me move on. I promised tonight to discuss the banking crisis a bit. So I'm going to do that. And then we'll come back to this question of the household and the breadwinner policy and Agenda 47 at the conclusion in roughly 20, 30 minutes. Well, say 20 minutes. But just on the banking crisis, it's on people's mind. And I think it's on everyone's mind. People have seen these failing banks, not only in California, but, banks in Tennessee and Arizona being threatened, their stocks dropping 30, 40% in the markets. And, obviously things are going haywire. The Fed policy of high interest rates after a period of interest rates at virtually zero, has trapped bank institutions into long-term treasuries, for example, that they bought when interest rates were near zero and money was being poured in during COVID into savings accounts and checking accounts. They took a lot of that money and put it into treasury notes because there wasn't a lot of demand for loans. Yeah, well, those treasuries are paying, 1% interest. Now interest rates at 5%, inflation's at 6%, and so on and so forth. This is having major consequences. This abrupt rupture in terms of policy. And of course, this is all monetary policy. It has nothing to do with the real physical economy of the United States, except in a negative sense. But a study came out April 23rd. It's Stanford and it's Columbia University's professors from each of those two campuses were part of this study. The title of it was Monetary Tightening and U.S. Bank Fragility in 2023. Mark-to-market losses and uninsured depositor runs, ? All right. Well, this is just an academic study, and done, a few weeks, it came out just a few weeks after Silicon Valley Bank was shut down. That was on March 10th. Looking in the rear view mirror, I guess you could say, and projecting forward, this study just drew some obvious conclusions, or pointed to some obvious conclusions with some very upfront figures. They stated that, if you take the commercial banking system of the United States, that banking system right now has lost, as of when this study was coming out, roughly, $2.2 trillion in value. Now, the total value of the U.S. commercial banking system in terms of assets is 23 trillion. So as the study itself says, the banking system in the United States has lost 10% of its asset value, in the course of the last few months, in this crisis created by the loss of value of the financial paper of these banks. That's what mark to market is. Okay, the bank bought these treasuries and it had a face value of X amount of dollars, 10,000, 100,000 a shot or whatever. Okay, but now if they turn around and try to sell it, they ain't going to get that much for it because it doesn't pay an interest rate, right? So there's no market out there. So they're going to have to sell that at a steep discount if they sell it. So if you mark that treasury note, that item in their portfolio to market, you're going to take, those banks are taking a big loss. They're losing their assets. Their assets have disappeared right out from under them. So that's the essence of it. 186 banks, the study points out, are at risk of failure, 186. If half of their uninsured depositors, those are those large depositors over 250,000 we've been hearing so much about, decide to pull their money out of their respective banks. Of those 186 banks, 186 of them are gone. Now, parenthetically, I want to add a note because there's some confusion about that. It's also stated that, at least by one of the authors of the report, that half of U.S. banks are running on negative equity, which makes it sound like half of U.S. banks are about to blow out. That's a little much. That's more of a mixed bag. Equity is what's been paid in by the shareholders that own the bank. So, like with Silicon Valley Bank, when it was shut down, those owners, that owner equity was wiped out. They were gone. Okay. But across the entire banking system, to say that at the moment, half of them are operating at negative equity, well, we may be going there like Silicon Valley Bank. We're not there yet. We were in worse shape in 2007, 2008, 2009, but that, of course, is not much of it in the way of assurance. But just to state that, in particular, well, so these are zombie banks. I'm going to use that term now, and I'll come back to it. But you've got numbers of zombie banks like Silicon Valley Bank, banks that are out there, who, if you actually they were forced to mark to market. They've got some cushion in there until they sell those instruments. They don't have to mark to market. I mean, that's a simple way of putting it. These are zombie banks. 186 at least, just by approximation, and many more going in that direction. But I want to move immediately to regional and community banks. This is the backbone of our economy. I mean, this is, 70% of all construction and land development loans, 90% of all loans secured by farmland, ranchers and farmers. Those are from community banks and regional banks. Those aren't the big money-centered banks. Yet these are the banks, the community and regional banks, as you may have heard, that hold somewhere between 70 and 80% of all the commercial paper, commercial real estate loan paper in the country. And we'll get to that in a second. These are the banks, meanwhile, that are in the biggest trouble, potential trouble, because of these treasury notes, the markdown or potential markdown of these treasury notes. And this has, of course, been fueled by speculation against these banks that's being run by hedge funds and whatnot. Part of the shadow banking system we'll talk about in a minute as well. But these banks are already increasingly in trouble. Depositors are leaving. Their treasury notes are worth far less than their face value. Their portfolios are worth a lot less. But the biggest chunk of their portfolio is commercial lending. Lending for commercial real estate loans, for office buildings, multifamily, industrial. You can kind of imagine the rest, the kind of gamut of this kind of thing. And so let's get to commercial loans really quickly. Okay. So these banks have loaned out money for commercial activities, commercial real estate loans specifically. Okay, well, what is that like? Well, first of all, you should know that commercial real estate loans are normally only for 7 to 10 years, but they're amortized, say, to 30 years. You know, the loan isn't expected to be paid off for 30 years, but the full debt owed on the property that's been purchased, that the bank is taking part in financing. But the bank will only extend in terms of the initial mortgage for a period of 7 to 10 years. And then it has to be rolled over. It's got to be refinanced by that bank or somebody else. But what does that mean? Well, that means, for example, as just to quote Jeff Fine from Goldman Sachs, Goldman Sachs, he's their big real estate guru, wealth management and all that kind of thing. As he says, there's more than $1 trillion of these mortgages maturing in the next 12 to 18 months. That it's going to be almost impossible to finance because right now there's a shutdown, almost a shutdown in commercial real estate lending. All right. And so 4 to 5 trillion debt in commercial property, you know, out of which $1 trillion is going to have to be financed in the next 12 months or so, 12 to 18 months, you know, may have nowhere to go. There may be no recourse for financing, and therefore massive defaults are in the offing. And he calls for a partnership between public and private to figure out some way to manage this crisis that's going to be emerging, as he puts it, over the next 16 to 24 months. But it's going to be, you know, it's going to be up front faster and sooner. This is going to be front loaded. So now think of those local banks and regional banks that finance most of the economic activity in the country. You know, most of those lenders in towns and smaller cities and so forth, the United States, from these regional banks, commercial, they're within 7 miles of the local branch of that bank. They're not borrowing from, you know, a bank in San Francisco or Chicago or New York. You know, these banks go under. You're taking down the lifeblood of the actual portion, the remaining portion of the U.S. financial system that actually finances real physical economic activity. You know, that employs people, farmers, ranchers, industrialists, entrepreneurs of all kinds, machinists, manufacturers. That's what's going to hit it's going to hit its own real wall here in this meltdown that's occurring. This is real. So that's the commercial real estate market. But on top of that, there's derivatives, financial derivatives. There's what's called commercial mortgage-backed securities. I have to look at the page to keep the words straight in my mind. CMBS. These are financial derivatives, bundles of commercial real estate paper. And there's a whole market in that. So now imagine what that's going to be worth as all of this melts down, and is melting down now. And keep in mind that the banks we're talking about, the banks talked about in this Stanford, Columbia paper, for example, these are the banks that are also the buyers in the sense that they finance the new mortgages, and and if somebody wants to sell their property under distressed conditions or otherwise, these are the banks that they go to. But these banks are not, these banks are not lending, and they're not going to be lending. So you see that this is a a compounding process, a meltdown process that's going on. And it's not limited to office real estate, although that's a very significant part of it. 16% of commercial real estate lending is in office real estate. And if you take San Francisco, you've got a 30% or more, 30%, some say 40% vacancy rate. So it's becoming impossible for the owners of those properties to service their mortgages. So that's a feature. But additionally, you take multifamily housing. Now, you might think that's a booming market with rentals and so on. Well, in 22, multifamily housing prices dropped by 19%. It was already being hit by the impact of the ongoing Fed and expected Fed interest rate crunch. So this is broader. This is beyond simply the office portions. It's also retail. Retail is another section of the commercial market. It dropped by 21% last year. The value of real estate in that area. So all of this contributes to a growing number of walking dead out there, the zombie institutions around us, and I think there's a broader point that's just got to be made, and we should be asking ourselves, why invest in commercial office real estate in the first place? I mean, obviously we have these growing vacancy rates, but all of this, to a large degree, the skyscraper cities of today, are the result of decades of a service economy, a bloated service economy that cancerous, and that's the broader question, which goes back to what I mentioned earlier in terms of this need to right the ship, to change the composition of our workforce, our economic activity in the nation, to become again a productive nation. Now, from there, I just want to briefly go to shadow banking, and that may sound strange to you. And I want to just say, first off, shadow banking is not part of the dark web. And if you don't know what the dark web is, don't worry. But shadow banking is half of all global assets are owned by shadow banks. Half. All assets, financial assets in the world are owned by shadow banks. They're not owned by banks. Shadow banks are unregulated institutions or quasi-institutions that make money available. They lend money, or they offer lines of credit, to be more specific, but they're not regulated. They don't take deposits. They don't have savings deposit accounts, checking deposit accounts. So therefore, they're not regulated as banks are. And this area includes everything from hedge funds and equity funds. These are folks like the Carlyle Group, BlackRock, Bridgewater, the Mann Group out of UK, Citadel, KKR, Kellogg, KKR, I'll come back to it, Warburg Pincus. These are some of these outfits that you're talking about. They engage in a lot of activity. Of course, BlackRock has its exchange traded funds and so on and so forth, but they also, organize their signature line of credit to equity funds and hedge funds and so on and so forth. All of these institutions operate through a multitude of shells, legally created shells, in which they carry out a wide range of financial activities. And these lines of credit is the primary activity. If you think that's abstract, think of the title loan outfit, maybe down the street or around the corner in the next neighborhood on the other side of the tracks. Title loan companies, pawn shops, Where do they get their money from? They don't, they don't have checking accounts and savings accounts. Their money comes from investors, obviously shady in many cases. In the case of equity funds and hedge funds, a lot of that money comes in from offshore. It also gets parked offshore. This is part of why it gets called shadow banking, and it's not new. Bear Stearns, Lehman, what sunk them was shadow banking activity. They were offering short-term lines of credit to people that were long, that had long-term investments. But then when those long-term investments went bad, like those treasury notes, they couldn't pay back those short-term lines of credit. And that in a nutshell is the problem that we have here with now coming to a head again with shadow banking, is nobody knows what's out there in terms of their exposure to the impact of the Fed rapid turnaround from 0 to 5% plus interest rates in a matter of months, and what the fallout is on the investments, the lines of credit they extended, and the likelihood of their customers to pay it back. Because a lot, whether legitimate or otherwise, and many of them are legitimate companies entrepreneurs and so forth, that go to these shadow banking outfits, hedge funds, equity funds, and so on and so forth, to borrow, do so because they can't meet the strenuous conditions that banks require these days to make loans. So they go to these institutions because it's easier. The interest rate may be higher. Sometimes it's lower, but they go there to try to get a deal because they're trying to keep themselves in business. But what happens when they're caught up in this meltdown? Remember, as commercial real estate goes south, commercial real estate construction goes south, apartment buildings construction goes south. What happens to construction companies? And you can follow the, you can follow the domino chain all along the line. So I think that covers, at least in terms of highlights, what we're looking at here. This is on top of the derivatives bubble, on top of the commodity speculation, which of course is hedge funds and so on, and equity funds and banks are all involved in commodity speculation. But this is an addition. This is in addition to the question of the national debt ceiling crisis and the federal debt of 31.5 trillion now. This is a meltdown of the banking system itself in a new way. It's not mortgage-backed securities, but it's a lot of other securitized financial instruments that are giving way. And as Jeff Fine of Goldman Sachs says, he doesn't see it stopping anytime soon. And a Morgan guarantee, others. I mean, you can find the quotes. I mean, this is known in the financial community. This isn't a secret. So from there, I want to turn back. I think it's really important, having said all this, to turn back to say, let's go back to how we create a productive economy, and specifically in the terms we're talking about it tonight. The single breadwinner household. How do we, through a combination of bringing the costs down and bringing wages and standards of living more generally up, do we create the conditions once again for these more ideal conditions of life for family formation and for the development of our nation? And so I mentioned it already in terms of the elements, but just to repeat very briefly, including for people who may have gotten on since I started talking. But first, we do it by increasing productivity. That's through scientific and technological progress. That's not by speeding people up. It's not by gouging wages and saying, hey, I cut wages to my workers, and so I got more profits. Therefore, I'm more productive. No, that's not productive. We're talking about productivity in terms of the actual physical economy over time. As the nation reproduces itself from hour to hour, week to week, year to year, generation to generation. Secondly, by shifting the composition of the workforce, by turning the boat right side up, by moving once again to create conditions where the majority of our workforce is in productive employment. And we've done this before. Keisha, do you want to put up the bar diagram, Lyndon LaRouche's bar diagram? This will just help in discussing this, I think, a bit. But just to say, first of all, look, we've done this before. This is, in this sense, this is not rocket science, okay? Alexander Hamilton and George Washington, organized the debt of the United States at the end of the American Revolution to create a prosperous economy through the reorganization of the debt and creation of a national bank and national credit. Lincoln did it with the greenback policy. We were in an economic mess at that point. Lincoln reorganized the economy, as often said, by the time of the 1876 centennial, we were the manufacturing superpower of the world. That was the outcome of the Lincoln Revolution. We did it again. Many of you know this through your parents and grandparents, maybe great-grandparents. In the 30s, we were in a deep depression. Hobos, the equivalent then of homeless people, rode the rails, lived in tent cities. We were in a horrible situation. By roughly 1940, we had turned the economy right side up, in particular through the policies of the institution, the utilization of the Reconstruction Finance Corporation, also the Tennessee Valley Authority Project, and so on. We did this as a nation. So, okay, so just having said that, and we could talk about Kennedy as well, John F. Kennedy and the moonshot. This was again a turnaround of the U.S. economy out of Trumanism. But let's go to this. You see it here on your screen if you have a video connection here. But what we've got here is at the top, it's labeled total economy. This is a chart from 40 years ago by Lyndon LaRouche in one of his writings, used in teaching economics to students on campuses around the United States and then in Europe. But here you see on the left hand, the lower bar, you see it labeled productive households. That's your entire workforce. Those are productive is defined as those making physical changes on nature for humankind, for man. And that productive workforce, of course, that includes the aged, those who are retired, includes youth, those are part of the households, right? The extended families and so forth. That's your productive population, your productive, directly productive. That productive workforce, those are currently employed of that labor force. You see the arrow there going from left to right. That produces 100% of the production, the physical output. That's that large bar on the right. And you see that bar diagram is divided into sections. Bear with me here. I'll try to keep it brief. This is just a first brush on this for you, probably for a lot of you, but C down at the bottom, C is constant capital. That's the plant and equipment. That's the portion of the total output. At any point in time, you could be talking about a year or a generation or 1 year, but in whatever period of time you're talking about, the labor force is producing and reproducing the C, the capital that's needed to sustain the productivity of the economy at the current level, whatever that level is. the portion of the output that goes to maintaining the machinery, equipment, and so forth of production. Above that, you have V, which is the workforce. That's the portion of the output. And you can see there's an arrow that then goes from V and back on around to the workforce as a whole, to the productive households as a whole. That V is the portion of the output that goes back to maintaining, out of the 100% of output, that goes back to maintaining the entire current, former, and future workforce. Maintaining at the cultural level, the standards of living, the cultural level that it's at. Equilibrium, shall we say. But it's not equilibrium. Equilibrium does not exist. At the top of the bar diagram on the right, you have S, which is then divided into S prime and D. S is the surplus. That's what's left over from after you paid for C and V, necessary expenditures, maintaining your workforce, maintaining your plant and equipment. You have a surplus left over. A portion of that surplus goes to non-productive households. You see that at the upper left-hand side, non-productive households. That's necessary non-productive households, doctors, scientists, nurses, they're all necessary. They contribute to maintaining the productivity of the workforce itself, the productive households. And their contribution is realized through the maintenance of that capability. So that's a portion that goes to non-productive households. And then, of course, it also goes to the overhead, to just pure overhead, waste, also defense spending. You can think of what else it goes to. And then having subtracted out D, this portion that goes to non-productive households, then you have S prime left over. You have a surplus left over. This is in a healthy economy. A surplus left over that can go to reinvestment. It can go to reinvestment in the workforce, raising the wage levels. It can go reinvested back into C to improve the plant and equipment and so forth. But it's the surplus of output, the output above what is necessary to simply maintain the economy as it is, kind of stationary in one place, but to move it forward, to advance it. So these are physical categories. These are not, this is not money. This is physical output. Looking at it in the broadest kind of terms, just stepping back and looking at the process by which we have to reproduce ourselves from generation to generation. And that surplus that actually ends up going, S prime, that goes back into improving standards of living and expanding investment into science and medicine and so on, and expanding capital investment. That's critical because, of course, we run into finite resources. We've got to overcome those with new inventions, new productivity, new plant and equipment, and so on and so forth. So now, with that in mind, think about where we are today. Well, frankly, we're not maintaining C. C has been shrinking. Capital investment has been shrinking for decades. That's why that's part of the reason why only 8% of our workforce or less is now employed in manufacturing. There's been no investment in capital. We shipped that to other countries, right? We outsourced it, as they say. V, the portion of the output that should be going to maintaining our workforce, the households of our workforce, that's been drying up. It's been shrinking. That's why we have housing shortages. That's why, people don't make a living wage. They can't support families. What happened? Well, it all went into overhead, but not to scientists, not to doctors and nurses. They'll tell you that. It went into overhead in terms of a parasitical oligarchy and class of hangers-on that's a predatory class that consciously or unconsciously, I mean, paper shufflers, they're good people, they're just trying to make ends meet and support their families. But, they're trapped in those high-rise office buildings, to simplify it. You can disagree with me if you wish, but I think that's a good way of summarizing it. All right, so this is the problem. Well, what if we create once again a productive economy? What if we increase the number of productive households in the nation? What if we shrink that overhead, useless overhead, right? Over time, in a systematic way. We don't want to hurt anybody, but we can do this in a systematic way. Just as it got bad in the systematic way, it can get right in a systematic way if we put our minds to it. And in doing so, we can ensure then the basis for the breadwinner household, for a return to safe neighborhoods, stable jobs where the operator has a job or a series of increasingly productive and well-paying jobs over his lifetime, and he doesn't have to move to some other city. He doesn't have to scramble to find a replacement because suddenly this company has left the nation, and so on and so forth. So and we have the political forces, just to end on that. We have Trump, we have Agenda 47. It's on the table. We have this expansive network growing. It's no longer partisan. It's not bipartisan. It's a broad patriotic movement that's emerging. From Bobby Kennedy Jr. to Elon Musk to and of course LaRouche PAC and Trump and Agenda 47 and so much more. So we can do this, and if we grasp the basic nub of the problem and how it can be solved, we can do it that much better. And in terms of this financial mess, well, that's Glass-Steagall, that's bank reorganization, that's creating a national bank, and we can we've talked about that many times. We can come back to it again, but the real, what we really have to grasp here is what is the basis of a real producer economy, because we want to return our nation to being a producer nation. So thank you for your attention, and I look forward to your questions and comments.